So picture a wildly successful South African entrepreneur.
Right.
They've got two beautiful houses, a thriving commercial business, and, a highly diversified stock portfolio.
Sounds like the dream, really.
Right.
Ah.
But now imagine a single SARS audit or just one messy, unexpected commercial lawsuit wiping out literally 100% of that wealth in a matter of months.
Ouch.
Yeah.
Which happens more often than people think.
Exactly. And why? Because on paper, they committed the absolute cardinal sin of wealth building. They held absolutely everything in their own personal name.
It is the ultimate vulnerability, honestly. I mean, you
Yeah.
spend a lifetime accumulating these high-value assets, but because you never actually separated your legal ownership from your operational risk,
Yeah.
you've essentially just left the front door to your wealth wide open.
Yeah, totally unlocked.
Right. When liability strikes your business, your personal assets are the very first collateral on the chopping block.
Which brings us to the mission for today's deep dive. Today, we are exploring the mechanics of building what is essentially an asset protection fortress for you, the listener.
I like that term, fortress.
Yeah, it fits perfectly. We're going to look at the immense positive power of trusts in South Africa and how you can supercharge those structures using modern endowment policies.
And crucially, why executing this strategy requires a very specific methodology. You can't just wing it. We're going to be pulling heavily from the approach pioneered by specialized trust consultant Lumka Sturman.
Because the reality is, wealth protection in South Africa requires navigating this highly specific intersection of tax law, estate planning, and corporate structuring.
Yeah, you cannot build a fortress on intuition alone. You really need to understand the underlying architecture.
So let's break down the foundation of that architecture. Before we can even think about complex tax efficiency or, investment wrappers, we have to establish the core principle of asset protection.
Right. And it boils down to one thing, separating the risk taker from the asset holder.
Okay, unpack that a bit for us.
Sure. So think about the nature of the entities involved here. A business is inherently a risk-taking vehicle. By definition, it enters into commercial contracts, it signs leases, it hires and fires employees, it takes on debt.
Right, it's constantly in the line of fire.
Exactly. It is constantly exposed to liability. A trust, conversely, is a risk-averse vehicle. It's simply a fiduciary arrangement designed to hold, grow, and protect assets for its beneficiaries.
Okay, so you keep them totally separate.
Yes. When you legally separate the two, meaning your trust owns the underlying assets or the company shares, while your company carries the operational risk, you ensure that if the business suffers a catastrophic failure, your family's accumulated wealth remains shielded from those creditors.
Wait, stop there for a second, because I know exactly what the immediate friction point is here for the listener.
The control issue.
Exactly. If I take my commercial properties, my business shares, my personal investment portfolios, and I legally transfer ownership into a trust, aren't I basically just locking my wealth in a steel vault and handing the keys over to a complete stranger?
Right. How do you pay for your life if you don't own your money anymore?
Yeah. It feels like you're giving up everything you worked for.
That is the psychological hurdle every wealth creator faces, honestly. But it's a misunderstanding of how fiduciary control actually functions.
Okay, so you don't actually lose control.
You don't lose control, no. But the legal nature of your control shifts. You're no longer the quote-unquote owner acting on personal whim. Instead, you can act as a trustee.
Ah, I see.
Yeah, you help draft the trust deed, which dictates the strict rules on how those assets must be managed and distributed to the beneficiaries, which, by the way, typically includes you and your family.
So you're operating the vault just according to a set of legally binding instructions that you helped, right?
Exactly. You're still driving the car, you just don't legally own the title to the car anymore.
But the architecture fails if you try to be too clever, right? Let's talk about the mechanism SARS uses to tear these fortresses down.
Oh, absolutely.
Because if I am the founder who donates all the assets, and I'm the sole trustee making all the decisions, and I'm the primary beneficiary receiving all the money, I mean, SARS isn't stupid. They're going to see right through that setup.
They will pierce that veil immediately.
Yeah.
In South African trust law, that is referred to as an alter ego trust or a sham trust.
A sham trust, meaning it's just a fake front.
Exactly. SARS and the Master of the High Court, they actively look for the puppet strings. If there is no functional separation between your personal wallet and the trust's bank account, they will just treat the trust's assets as your personal assets.
So if a creditor sues you, the court will just collapse the whole trust and hand the assets over to them.
Yep, which is exactly why the legal requirement of an independent trustee is completely non-negotiable.
Right. It's the keystone of the entire structure.
It really is. An independent trustee, and that means someone who is not a beneficiary and not related to you, must be appointed. They ensure the trust is managed impartially and actually complies with its fiduciary duties.
So their presence legally proves to SARS that the separation of control is actually real.
Exactly. You are no longer just moving money from your left pocket to your right pocket whenever you feel like it. You are making joint, minuted decisions in the best interest of the trust itself.
Okay, that makes sense. And the mechanism kind of changes depending on what phase of life you are planning for, right?
It does, yeah. There are a few different types you need to know about.
Like, if I need this liability shield today, I'm setting up a living trust or an inter vivos trust to hold my assets right now.
Correct. That's for while you're alive.
But if I am strictly thinking about what happens when I die, the mechanism shifts to a testamentary trust, which only springs to life through the instructions in my will, right?
Exactly. Or you might even use a business trust, which is specifically designed to handle corporate succession without, disrupting operations when a founder exits.
But the overarching benefit across all of those structures, beyond just the liability shield, is generational wealth preservation.
Yes, because a trust doesn't die.
Hmm.
So it stops wealth from being fragmented, heavily taxed, or just mismanaged every single time it passes to the next generation. The capital remains intact, compounding over decades.
Okay, but that brings us to a massive, glaring problem. We have to talk about the tax drag.
Oh, yeah. This is the big one.
Because while the legal protection of a trust is phenomenal, the tax implications of compounding wealth inside one in South Africa can be brutal.
It is a severe penalty.
Mhm.
If a trust retains its income, meaning it earns interest or rental income, and does not immediately distribute that cash out to the beneficiaries, that retained income is taxed at a flat rate of 45%.
Wow. 45%.
It gets worse. The effective capital gains tax rate for a trust sits at 36%.
That's just wild. If you are trying to aggressively compound wealth over a 20-year horizon, a 45% annual tax drag is absolutely crippling.
It really is.
It's like trying to run a marathon with a parachute tied to your waist. Every time your investments generate a return, SARS is taking nearly half of the yield before it can even compound for the next year.
That is a great analogy. So how do we solve this? Because we don't just accept the penalty for the sake of the liability shield.
Right. And this is where we bring in the second architectural element,
Mm.
the modern endowment policy.
Now, we need to address the historical baggage here immediately.
Yeah.
Because I know what people are thinking.
Yeah, the word endowment gives people hives.
Exactly. When many South African investors hear that word, they instantly think of those rigid, opaque savings policies from the 1980s and 90s.
Oh, the classic pay into this black box for 20 years and hope for the best product.
Yes. The ones loaded with hidden commissions, terrible underlying performance, and just massive penalties if you try to change anything.
But a modern endowment is entirely different, isn't it?
It is night and day. It is not an investment in itself. It's a highly sophisticated legal wrapper. Think of it as a tax-proof container.
Okay, so how does that work in practice?
Well, you can take your existing high-performing offshore unit trusts, your balanced funds, or your money market accounts, and you simply place them inside this endowment wrapper.
Let's break down the mechanism of how that wrapper actually bypasses the trust's 45% tax rate, because it fundamentally changes who legally owns the asset, right?
Spot on. When you place those investments inside the endowment, the life insurance company that issues the policy becomes the legal owner of the underlying assets.
Okay.
You, or your trust, simply own the policy itself, which is just the right to the future value of those assets. Because the life insurer is the legal owner, they pay the tax on behalf of the policyholder using a specific corporate tax rate governed by the five funds tax approach.
And the numbers are staggering when you look at them. Inside that wrapper, income like interest is taxed at a maximum internal rate of 30%,
Yes.
and the effective capital gains tax rate drops to roughly 12%.
Just look at the delta there. If your trust is paying 45% on retained income, and you move that exact same underlying investment into an endowment wrapper paying 30%, you have instantly clawed back 15% of your wealth from the taxman every single year.
That is huge. I mean, Lumka's methodology highlights a fantastic scenario with a high net worth individual. Let's call her Sarah Mitchell.
I love this example.
So Sarah has 2 million rand to invest over a 10-year horizon. If she invests it directly through her trust, that 45% tax drag continuously eats into her compounding returns. And after 10 years, the capital grows to roughly 4.2 million rand.
Which isn't bad, but watch what happens next.
Right. If she takes that exact same, say, Allen Gray or Coronation Fund and structures it inside an endowment wrapper, she secures that 30% internal tax rate. After 10 years, her capital sits at 4.6 million rand.
That is a 400,000 Rand advantage generated purely by changing the legal container.
Exactly. The underlying market risk didn't change at all. The investment strategy didn't change, only the tax architecture changed.
And when you stretch that compounding effect over 20 or 30 years, the difference is literally measured in millions.
But of course, the tax man doesn't just hand out a 15% discount out of the goodness of his heart. There is a catch, and we need to explore the mechanics of the 5-year rule.
Yes, the 5-year rule is critical. By law, an endowment policy is restricted for the first 5 years. You are generally allowed one loan and one surrender during that period, but the access is highly, highly limited.
So it is strictly a medium to long-term wealth-building tool.
Exactly. Do not put money in there that you need next year.
And what happens if someone ignores that? Say there's a massive emergency in year 3, they break the glass, and they pull all their capital out of the endowment.
They trigger what's called the recoupment rule, and the mechanics of it are extremely punitive.
Like how bad?
SARS essentially reverses the entire tax benefit. They recalculate the growth as if the endowment wrapper never even existed. They add those proceeds back into your personal taxable income at your marginal rate, and they apply penalties.
Wow. So you completely destroy the structural advantage you were trying to build in the first place.
You blow it up entirely, which reinforces why this requires holistic planning. You do not put your emergency fund or your operational cash flow into an endowment.
Right. You use liquid structures on the outside for immediate needs, and you deploy the endowment inside the trust for long-term, highly efficient generational compounding.
Exactly. The fortress has different rooms for different purposes.
Okay, so we've solved the tax drag while you're alive. The trust protects the assets from creditors, and the endowment wrapper grows those assets efficiently.
Yep, that's the living strategy.
But there is a ticking clock here. What happens the moment you pass away? Because having a perfectly tax-efficient trust doesn't help at all if your family is locked out of it when they need it most.
This brings us to one of the most traumatizing and honestly least discussed financial realities in South Africa: the estate freeze.
Walk us through the step-by-step reality of what actually happens when a high-net-worth individual dies in SA.
Okay, so the moment a death is reported, the Administration of Estates Act kicks in immediately. The individual's entire personal estate is legally frozen.
Everything.
Everything. All bank accounts are locked. Credit cards are stopped dead. Debit orders start bouncing. Properties cannot be sold, and business shares cannot be transferred. The Master of the High Court must appoint an executor and issue letters of executorship before a single cent can be moved.
And realistically, in the current South African bureaucratic environment, how long does that actually take?
You're looking at months. Frequently, it takes over a year just to get the administrative wheels turning.
About a year.
Easily. And during that entire blackout period, the surviving spouse and children have zero access to funds in those accounts.
That's terrifying.
It is. You could have a business owner who's worth 20 million Rand on paper, but their family cannot access enough cash to buy groceries, pay the mortgage, or keep the kids in school. They are wealthy on paper, but completely impoverished in reality.
It's like dying of thirst while staring at a locked vault full of water.
That's exactly what it feels like for the family left behind.
But this is where the tools we've discussed create what I like to call a financial bypass valve. We can completely circumvent the Master of the High Court.
Yes. We do this using the unique legal structure of the endowment policy. Because an endowment is technically a life insurance product, the legislation allows you to nominate a specific beneficiary.
Let's look at the mechanics of this bypass valve. Suppose I, as an individual, own an endowment policy in my personal name. I enjoy the 30% tax rate on my investments while I'm alive.
Right.
But on the policy documents, I officially nominate my family trust as the sole beneficiary. What happens then?
The moment you pass away, the mechanics of the life insurance wrapper supersede the estate freeze.
Meaning it ignores the Master of the High Court entirely.
Totally ignores it. The policy pays out directly to the nominated beneficiary. It never enters your personal estate. It never crosses the desk of the executor. It is entirely ring-fenced from the Master of the High Court's delays.
That is brilliant. Lumka's methodology uses the example of William Thompson to illustrate this, right?
Yes, the William Thompson case study.
So William is a successful commercial consultant. He puts 50,000 Rand a month into a personal endowment policy. He gets the tax benefits for years. Then William suddenly passes away. His personal accounts are frozen immediately. The estate is locked down.
But because his family trust was the nominated beneficiary on that endowment, the life insurance company simply requires a death certificate.
Yeah.
Within a matter of weeks, they pay the accumulated 5 million rand directly into the trust bank account.
Instant tax-free liquidity.
Instant liquidity. The independent trustees now have 5 million rand in a fully functioning, legally protected structure.
So they can immediately step in, pay the widow's living expenses, settle any urgent business debts to keep the company afloat, and just manage the transition smoothly.
Exactly. The family bypasses the bureaucracy entirely. It is the ultimate integration of these tools. It marries the tax efficiency of the endowment with the protective liability shield of the trust, specifically to solve the real-world cash flow crisis of a deceased estate.
Now, listening to the mechanics of this, the 30% tax arbitrage, the independent trustee requirements, the estate freeze bypass, it is incredibly powerful.
Extremely.
But it is also highly complex. If you are an entrepreneur listening to this, you might think you understand the theory well enough to just download some legal templates, copy-paste a trust deed from Google, and set this up yourself to save on consulting fees.
Which is the fastest way to guarantee your fortress collapses the moment it is actually tested.
Setting up a trust yourself is like trying to write your own complex software code by copy-pasting lines from a forum.
Right. It might look like a working application on your screen.
Yeah. But the second a hacker, or in this case, a hostile creditor, or a SARS auditor, tests the defenses, the entire system crashes because the underlying logic is fundamentally flawed. If your structures don't align perfectly, the courts will rip right through them.
This is exactly why Lemke Sturman's methodology as a trust consultant is so critical. She doesn't just act as a legal typist filing documents at the master's office. She acts as the master architect for your entire financial structure.
Let's talk about how an architect actually approaches this, specifically her concept of a foundation audit. Because a good consultant doesn't start by just selling you a trust, do they?
No, not at all. They start by looking for the structural weaknesses in your current setup. In a foundation audit, which Lemke offers for, I believe, 25,970 rand, she thoroughly examines the fault lines between your commercial risk and your personal assets.
So she's looking at the whole picture.
Exactly. She looks at how your company shares are held, where the dividend flows actually go, and what personal guarantees you've signed. She determines if you are actually ready for a trust, or if you simply need to clean up your corporate structuring first.
And if a trust is required, she offers what she calls an asset protection blueprint session, leading up to a full asset protection fortress setup.
Right. And her methodology focuses heavily on the actual operational reality of the structure. Setting up a trust might legally take 2 to 4 weeks, but ensuring it survives a SARS audit a decade later requires ongoing compliance.
And that's where people drop the ball, isn't it?
That is the most common failure point. People think a trust is a file you just stick in a drawer and forget about.
Yeah.
It isn't. A trust is a living legal entity. It requires annual trustee meetings, meticulously minuted resolutions, independent accounting, and completely separate tax returns.
Because if you fail to maintain that corporate governance, SARS will just declare it an alter ego trust and strip your protection away.
Instantly. Lemke's approach includes comprehensive education and annual maintenance to ensure you actually know how to operate the machine you've built. She teaches you how to maintain the fortress.
You wouldn't wire the electricity in your own house to save a few bucks because one mistake and the whole thing burns down. The same goes for setting up a trust that needs to stand up to a SARS audit or a lawsuit.
Exactly.
For any business owner or high net worth professional listening who realizes they are currently exposed, understanding these mechanisms is the very first step. You can explore Lemke's educational resources, understand her audit methodology, and start assessing your own structural risk by visiting her website at www.lemkosterman.com.
Because the integration of corporate law, tax compliance, and estate planning is simply not a DIY project. The stakes are way too high.
So let's synthesize everything we've unpacked today. We started with the immense danger of holding wealth in your personal name, exposing a lifetime of work to commercial liability.
And we solve that by establishing the asset protection fortress, using a trust to legally separate the risk-taking business from the asset-holding family wealth.
We then addressed the brutal 45% tax drag of the trust by introducing the modern endowment policy wrapper.
Right. By legally shifting the ownership of the investments to a life insurer, we drop the tax on growth to 30%, which vastly accelerates generational compounding, provided we respect the 5-year liquidity rules.
From there, we engineered the financial bypass valve. By holding a personal endowment and nominating the trust as the beneficiary, we ensure that when death occurs, liquid capital flows directly to the family in weeks.
Completely bypassing the devastating months-long freeze of the Master of the High Court.
And finally, we establish that architecting this integration requires specialist methodology. It requires someone like Lumka Sturman, who understands how to align the legal deeds, the tax strategies, and the ongoing corporate governance so that the veil of protection is never pierced.
It really is a profound shift in how you view wealth. You stop thinking about just accumulating money and you start thinking about structuring legacy.
Which leaves us with a critical paradigm shift to consider for the listener.
Yeah. We spend our entire lives obsessing over how to generate wealth, how to read the markets, and how to scale our businesses. But we spend almost no time thinking about how that wealth will behave when we are no longer here to guide it.
That's so true.
A properly structured trust isn't just a dry legal entity. It is effectively a time machine. It is the only vehicle that allows your deepest values, your desire for family protection, and your hard-earned financial wisdom to continue actively parenting and guarding your children and grandchildren long after you're gone.
The ultimate final instruction.
Exactly. The question you have to answer today is, if your wealth successfully outlives you, what specific instructions will it leave behind?